In October 1907, the New York Stock Exchange nearly ceased to exist, and one man's private fortune stopped. The early 1900s were a time of explosive growth and fragile confidence. America had no central bank. Instead, a loose network of private banks, trusts, and speculators moved money around like players in an unregulated game. When confidence cracked, and it always did, there was no backstop, no lender of last resort, no circuit breaker. By autumn 1907, a cascade had begun. A failed copper speculation, rumors of bank failures, depositors lining up outside institutions, demanding their money back. The panic spread like wildfire through New York's financial district. Banks that were solvent on Monday looked insolvent by Friday, not because they were broken, but because everyone believed they were. By mid-October, the stock market was in freefall. Brokerages faced collapse. The entire credit system was seizing up. And then J.P. Morgan, the most powerful banker in America, stepped in, not as a government official, as a private citizen. Morgan gathered rival bankers in his private study. He cajoled, threatened, and persuaded them to pool their capital and inject it into the system. He personally guaranteed deposits. His reputation, his word, became the collateral that stopped the panic dead. Within days, confidence returned. The crisis passed. But Morgan's intervention exposed something the nation couldn't ignore. America's financial system depended on the goodwill of a single private citizen. What if Morgan hadn't acted? What if he'd been out of the country? The system had no institutional safeguard. Congress couldn't unsee that vulnerability. Over the following years, momentum built for a permanent solution. In 1913, the Federal Reserve Act was signed into law. America finally had a true central bank, an institution designed to do what Morgan had done alone, stabilize the system during crises. The Panic of 1907 wasn't just a financial event. It was the moment America realized that markets need structure, that confidence requires institutions, not just individuals, that a modern economy can't survive on luck and reputation alone. Today's Federal Reserve traces its DNA directly to that moment in Morgan's study. Every time a central bank steps in during a crisis, every circuit breaker, every safeguard, they are all echoes of 1907. Understanding this history shows you how modern finance came to be what it is. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe to explore more pivotal moments that shaped how money, power, and systems evolved. Subscribe to explore more pivotal moments that shaped how money, power, and systems evolved. This video is for educational and informational purposes only and is not financial advice. Always do your own research.